Hi, Carrie. Ta-da, here we are. How you doing? Okay. What chapter are we up to here? Let's figure this out. You're muted.
The last lecture I heard was chapter 10, but I haven't been here for a week and a half, so.
Yeah, we went through chapter 10. Let me just triple check the module real quick.
Okay.
Come on, come on. Okay, I'm getting close.
Okay.
You just took a test, didn't you? Or no?
Yeah, I took it a few days ago because I was out of town. So,
Okay. Chapter 10. October 6th. Okay, I guess chapter 10 it is.
I know we did chapter 10.
Okay. Then we'll hit chapter 11. That means we're just getting a little ahead of the class. Okay, chapter 11. That was
Accounting for sales.
yeah, we did accounting for sales already.
Yeah.
Chapter 11 is the purchasing side. So give me a second here.
Accounting for purchases and cash payments.
Yeah.
Okay, got it.
Okay. In chapter 10, we did the sales side. Just give me 1 second, Carrie, real quick, right there. Okay, now I'm amped up. In chapter 10, we did the sales side, right?
Yeah.
We talked about contra sales accounts like sales returns and allowances, sales discounts, credit card fees. Here we're doing the mirror image of it in the world of purchases. And in purchases, there's a little more complication. So let's go through this here. Purchases. What are purchasing activities? We know that. These are the forms that are usually used in terms of ordering something at a bigger company. On the test, they like to ask you about these different forms. A purchase requisition, that's just what it sounds like. It's just a request to buy something. You fill it out and you hand it to your boss. If your boss says, okay, you can have that new computer, they'll turn it over to the purchasing department and who will create a purchase order. Then the goods arrive and someone signs off on a receiving report and you're going to get an invoice in the mail. You're eventually going to staple all of those together and wait until it's time to make the payment on the bill. So just be familiar with those 4 forms there, okay? The purchase requisition can be requested by just about anybody, and it can be prepared by any authorized person, and then copies go around. And there is a requisition. Looks just like an invoice, huh? In fact, that's the fanciest requisition I've ever seen. Usually it's almost a blank piece of paper where you kind of just write out what you need. The purchase order, that's the contract between the buyer and the seller. Once the purchase order is agreed upon, we have a deal. And purchase order looks like the invoice again. And a receiving report, probably the most important one. The computer arrives at your store, at your business, and somebody brings it into the building and signs off that they counted what was there and it's the right items. And then, of course, the invoice, the bill that comes. Remember we talked about sales discounts in chapter 10?
Mhm.
In this chapter, we're going to call the same discounts cash discounts, okay?
Okay.
Oops, excuse me, let me stop that. In this chapter, we're going to call them cash discounts.
Uh-huh.
They were contra revenue accounts. Here, they're going to be contra purchase accounts because we're debiting purchases for all the things we buy.
Yeah.
Let's understand what a trade discount is. A trade discount is not recorded in the financial records at all. A trade discount would be you get a bill from somebody perhaps, and the bill said one item at $1,000, and then it said less 20% discount. So the price comes down to 800. You work with the 800. You don't fool around with that trade discount, okay? It's a reduction from the list price for certain customers. It'll often be in a catalog. You look in a catalog and you see something that says it's $1,000 each, but 25% off. So you ignore that 25% off and you work directly with the 750 in that case. And here's an example of it here. It won't let me zoom. Yeah, you see where it says less discount, 10% carry.
Yeah.
That just means when we buy it, we're putting it into our records at 684. We're not going to record it at 760 and
Right.
recognize some kind of silly discount, okay?
Got it.
Okay, here we go. Gross profit we're going to talk about. This is something new, okay?
Mhm.
Sales minus cost of goods sold equals gross profit. Sales minus cost of goods sold equals gross profit. Sales, we sold something for $1 million. We paid $500,000 for those goods. That would be our cost of goods sold. And the difference would be the gross profit.
Got it.
So we're starting a new income statement here. So look at the accounts we have. Instead of sales, now we have purchases.
Mhm.
We don't have sales returns. We have purchase returns and allowances, purchase discounts, and we're going to throw freight in. The freight charge carry becomes part of your purchases, part of the inventory, okay?
Mhm.
And here they're just introducing you to get a look at your new accounts here, okay? Oops,
Where is it? Wait, yeah. So where does it go?
the freight
Okay.
in?
Got it.
Yeah, so you have purchases, then you have the reduction in purchases, and then the freight would be in addition to the purchases.
So why does it say purchase discounts there?
Because we're doing the purchase side right here.
But
Oh, you mean instead of a cash discount?
no. You just said when you're talking about trade discounts, you don't record it.
That's
So
correct.
why do you have purchase discount?
That really should say cash discount. That's the cash discount we're talking about. That's the 210 net 30.
Oh, I see. Okay.
Yeah, they put purchase discounts. Yeah, it can be called a purchase discount, but typically it's a sales discount on the seller side, a cash discount, or I guess purchase discount on the buyer's side. Purchases account. Used to record the cost. In this chapter here, when we buy something, it's not going into inventory, it's going into a cost account. And then at the end of the month, we have to count the inventory to straighten everything out. So we're writing all of the purchases to the purchases account. And you never credit purchases, just like you never debit sales, you never credit purchases. What you have to credit are the purchase returns and allowances, okay? Or what they started to call purchase discount. So very simple, we made a purchase, we debit purchase, we credit accounts payable, nothing fancy there. A contra purchase account used to record purchase returns and purchase allowances. That's our purchases, returns, and allowance. It's a contra cost account, contra purchase account. It's a cost account that has a credit balance, and it's credited for the amount of the sales returns, and you will never debit it. We don't care about closing it. And here they just bought merchandise on account, so nothing onerous there. And here, it looks like they returned something, okay, Carrie?
Mhm.
They returned something. They returned $200 worth of goods. Well, this company no longer owes $200. We don't owe that $200 anymore. So we get the debit accounts payable. And since we never credit purchases, we're going to credit purchase returns and allowances. Just
Okay,
like
so your business purchased something for $200 and then you returned it.
yes,
We're doing the
Yep.
returning. Yeah, okay.
right. And then in chapter 10, that would have been a debit to sales returns and allowances. Here it's a credit to purchase returns and allowances, okay?
Mhm.
Same transaction. Assume the same merchandise is retained, but the seller grants a price reduction of 45. This would be an example of a sales allowance, if you will. We wanted to return the goods for $200, and the selling company said, look, we don't want it back either. How about we knock the price down $45 and you keep it?
Mhm.
So that reduces accounts payable by 45, and you credit purchase returns and allowance, and we have to pay the 155 difference.
Okay.
Purchase discount accounts, purchase discounts, a contra purchase account used to record these things. The account is credited for the discount. And here we go. Now we're paying a bill, okay, Carrie?
Yeah,
We owe $100, right?
yeah.
So we debit accounts payable $100, that wipes that out. And we are able to retire that debt with just $98 in cash. And the difference is a cost reduction of $2. So that's pretty clear, Carrie?
So you're getting a cash discount.
That is correct, because we paid within 10 days, or whatever the terms were,
Okay.
okay?
Mhm.
Freight in is an adjunct, hey, it's an adjunct like me. An adjunct purchases account used to record transportation charges on merchandise purchases, and it's debited, it's an expense, okay? And it's considered part of your inventory, and that's why we have to put it in with the purchases, okay? You're gonna come to what they call net purchases, and then the next line will be add in the freight. Freight in,
So that's the shipping charges you have to pay.
exactly right. The cost of trucking the goods in,
Okay.
or UPS or whatever.
Mhm.
Have we talked about FOB at all?
No,
Okay, hold on. Breakfast of champions here. FOB shipping point, FOB destination. Free on board. This is an important concept to understand, Carrie.
uh-huh.
Free on board. What it means is the exact moment in time where title to the goods changes, okay? This is the exact point in time where the buyer now owns the goods and not the seller.
Mhm.
If the goods are shipped FOB shipping point, it means that as soon as that truck leaves California,
Mhm.
I own it in New Jersey.
I
That
see.
means that I'm responsible for paying the freight as it goes across the country.
I see.
If there's an accident, it's my insurance that is responsible for handling it, okay?
Really? Even
Yes,
before you receive it?
it's mine. If it's FOB shipping, you're shipping to me in New Jersey. Your
Uh-huh.
truck leaves your store in Santa Barbara
Uh-huh.
and has a little accident before you even get on the freeway. I, in New Jersey, am responsible for that, my
Wow.
insurance, because I own the goods at the shipping point.
Mhm.
FOB destination is different. FOB destination means that as those goods are traveling across the country, you, the seller, still own them and are responsible for all the problems that might occur.
Mhm.
If that truck gets within 100 yards of my store in New Jersey and there's an accident, the seller is responsible. So the FOB shipping point, FOB destination, it's kind of an important concept to have in the back of your mind. They'll ask a couple questions about it on the test. When you get into 230, we get into it in a lot more detail. It can be very strategic for a company about these terms. I worked for a company where we could borrow against assets, okay? And quite often at the end of the month, we didn't have enough money to pay the payroll. So I would call our supplier in Oklahoma and ask him to put a train load of resin on the rails and ship it FOB shipping point. At that immediate moment, now I could debit inventory in my financial statement and credit accounts payable and thus borrow 80% of that back. So there's a certain strategy here. Also, you're selling to me and you said, okay, Bob, it's a deal. How about I ship it FOB shipping point? If it was me on the other end, I'd say, no way, ship it FOB destination. I want nothing to do with it while it's on the way.
Right,
Okay?
So you're saying for financial reasons, FOB shipping point would be more desirable, but as a customer, FOB destination would be more desirable.
Yeah. And we're not talking about sales between the public and a store. There's no such thing. This is between like a retailer and a wholesaler, big truckloads we're talking about.
Right.
But the FOB.
I mean, but what's more common?
I'm thinking that destination would be more common.
I would think
I really don't know, but that would be the simple way to do it.
Yeah, I would think. Yeah.
I don't own it until I actually receive it.
Right.
That would be very frustrating. You're waiting for something to arrive, and not only doesn't it arrive, you have all of a sudden have to pay insurance or something on it. So
right. Yeah.
And here's an example of freight. Here, in this example here, we got the bill from the supplier, and he included the freight charge on his bill. You see that $38 there, Carrie?
Yeah.
He just sent us a bill, and the bill said one item at $400 plus freight. You owe the vendor $438. Okay.
Mhm.
Or the vendor said to the freight company, bill my customer directly.
Mhm.
So that's why you have two transactions, one for the 400 and then a separate one for the $38 that you got from Red Ball Trucking or something, okay?
Mhm.
Yellow freight. Now we're going to get into something a little more detailed. Hopefully you find a little bit interesting as we come up with a financial statement, okay?
Mhm.
Portion of a financial statement. Computation of gross profit. Like I said before, it's the difference between net sales and cost of goods sold. Net sales, cost of goods sold. Your net sales were $100. That's the sale. You paid $60 for those goods that you sold for 100. That's your cost of goods sold. The difference is called gross profit.
Mhm.
Now look at all these numbers we have all of a sudden, huh? They're giving us sales returns and allowances, and sales discounts. And they're giving us the purchases, purchase returns and allowances, and purchase discounts, and the freight. And we know those are all of one world. That's part of the purchases. And then they're giving us the beginning and the end, the inventory. Now, why are they doing this? We want to compute the gross profit. So before we can do the gross profit, we have to compute the cost of goods sold. So we start with these 4 steps. Step 1, compute the net sales. So the net sales would be the sales minus the returns and allowances and discounts. So we'd start our financial statement off by saying gross sales, 201,500, less sales returns and allowances, less sales discount. That'll give us our net sales, okay?
Mhm,
Now we have to come up with the cost of goods sold, okay?
mhm.
The cost of goods sold. But first they're suggesting we compute the goods available for sale. That's the beginning inventory plus the cost of goods purchased. So think about that. At the beginning of the month, we had 1,000 books in our bookstore, and
Mhm.
then we brought in 9,000 more books. That's the most we could have sold, right? 10,000 books.
Yeah,
That's the goods available for sale. So let's get the available for sale. The goods available.
wait. So wait, you have your beginning inventory plus cost of goods purchased. Wouldn't that come out of that inventory?
Yeah, of course. That's what we're computing right now. Yeah.
Okay, so you have your beginning inventory,
Plus
and
the purchases that you
you're
brought in.
adding, wait, you're adding what was purchased?
Yes.
Wouldn't that reduce the inventory?
No, we're on the purchasing side. We started off with the inventory in this example here. Hold on one second. In this example here, we had an inventory at the beginning of the month, $26,000.
Mhm.
During the month, we brought in another 105,000.
Okay,
So it's increasing our inventory.
okay,
So the point at this level here is the beginning inventory plus your purchases and freight would be the goods available.
got it. Okay,
That's the most you could have sold.
okay,
Okay, so we understand that concept.
got it.
Now all we have to do is subtract the ending inventory from the goods available. And
Yeah.
you'll see this laid out in the statement in a moment. Cost of goods available, Carrie, at the end of the month, the cost of goods available can only be in two places, at only two possible places. We either sold it, in which case it becomes part of cost of goods sold, or we still have it and it's still in the inventory,
Right.
okay?
Mhm.
So by subtracting the ending inventory from the available, we're backing into the cost of goods sold.
Got
And now that we have the cost of goods sold figured out, we can do the gross profit, which is net sales minus cost of goods sold. And let's take a look at it here. Move that out of the way. Okay, so they're working with all those numbers there, right, Carrie?
Mhm.
Our gross sales were 201,500 minus returns and allowances minus the discounts. That gets us net sales of 799.3.
199.
199.3, thank you. And now we go through the cost of goods sold calculation. It looks like a lot, but if you just divide and conquer, it's not too bad. You have the beginning inventory
Mhm.
plus your purchases
Yep.
and freight gives you the total purchase. You add them together, that's what's available.
Mhm.
At the end of the month, we went out and counted the inventory, and we said there's still $18,000 worth of goods in our warehouse. Therefore, we sold $111,500 worth of goods at cost.
Okay.
Okay. So now we have the cost of goods sold. We have the net sales, 199.3. We have the cost of goods sold, 111. We have the cost of goods sold, 111, and there's our gross profit. Okay.
Okay.
If you were in our class, if we had this class in the classroom, you'd get a problem where you'd have to put the statement together. On your test, they'll, obviously, it's going to be multiple choice questions. They'll be piecemealing it,
Right.
They'll give you a question that says total available minus cost of goods sold equals what? And you
Right.
have to be able to figure out that's the ending inventory. Okay. So that's really not too bad, huh?
No, not too bad.
And now, believe it or not, we're getting toward the end of this chapter. Describe and use the accounts payable ledger. You remember the accounts receivable ledger from chapter 10?
Mhm.
Same thing. You're going to have in the general ledger, you're just going to have one number there for accounts payable. the general ledger doesn't tell you who the people are. The accounts payable ledger does that. Just like in the general ledger, you have a folder for cash, a folder for accounts receivable, etc.
Mhm.
In the accounts payable ledger, you have a folder for each vendor and what you owe them, okay?
Yeah, okay, sure.
So it's a separate subsidiary ledger, subsidiary. The general ledger is called the control ledger.
Mhm.
And here they're showing purchases, and each of these is the same exact event. They purchase something on a particular date. So let's see how they handle that. And they're just showing you the journal entry. That's easy enough, huh?
Yeah.
Debit purchases, credit accounts payable. That was true for all of these people here. Posting to the general ledger. Well, I think we can skip this slide because we kind of know how to do this already, right? We've been doing it since the beginning of time here. There we go. There is our journal entry, right? Accounts payable, $3,000. There it goes down into the general ledger, $3,000.
Mhm.
There's the purchase side, the debit. So you don't have any trouble with that, I wouldn't think, huh, Carrie?
No, I just have to take time.
Yeah, you just bring it over the debits and credits.
Yeah.
Now we're posting to the accounts payable ledger, and it's the same exact process. Can you read those numbers, Carrie?
Sort of. Yeah.
Okay, here's what we just did. Remember, we brought the numbers down to the general ledger.
Yeah.
Now we're doing the same thing with the accounts payable ledger.
Yeah.
Accounts payable ledger is going to consist of all the people to whom we owe money.
Okay.
Blankly, credit, we paid, looks like we paid them, or rather there's a credit balance. We owe Blankly 3,000. We owe this one $2,500.
Mhm.
Okay. So no, there's no mystery with that, I don't think, huh?
Right.
Come on. Posting purchase returns. We returned $200 worth of material. Part of the purchase is made on the 23rd. The $200 debit is posted to the accounts payable controlling account, just like you would expect. So here we go. We had a return, right? We returned $200 worth of things, and we had a debit accounts payable at that point, right?
Yeah.
So that $200 from, who's this, Rand's Design,
Yeah.
is going to have to be recorded as a reduction here in our debt to him.
So
$200
you post it to the accounts payable what?
ledger.
No, contra? I mean,
Yeah, it's called the contra account, the
Yeah.
purchase returns allowance. It's a contra cost account.
so when you're posting purchase returns, you post to which account?
Accounts payable. The accounts payable ledger reflects all the debits and credits just to accounts payable.
Okay.
It's your subsidiary.
Which is the contra account?
Purchase returns and allowances.
Okay.
Accounts payable would be a control account
Control account.
because that exists in the general ledger.
Yeah. Okay. Got it.
The subsidiary account would be the detailed type accounts, the purchase discounts, purchase returns and allowances.
Okay.
But in the accounts payable ledger, we're only interested in the debits and credits to accounts payable. Okay.
Right.
And Gunnar made some payments here. Gunnar, they paid $4,800 for purchases made on account. And then they paid less a discount. So let's take a look at this. Gunnar owed $4,800, and they're just making a simple payment, right?
Right.
Credit cash, debit accounts payable.
Mhm.
The other one, Gunnar, we owed Gunnar $8,700. So now we get to debit accounts payable, right? 8,700.
Mhm.
But there's a 1% discount we were able to take. So we were able to settle that debt for just $8,613.
Mhm.
Make sense?
Yeah,
Okay. And now they're just showing you posting the cash payments. Again, all we're interested in, Carrie, is wherever we see accounts payable in terms of the ledger, in terms of the AP ledger. So here we had 4,800. This customer, we no longer owe him any money, and we no longer owe Gunnar that 8,700. Okay? The accounts payable ledger just tracks all the debits and credits to one account only, accounts payable.
Mhm.
General ledger, we're picking up all the others.
So, okay, wait, sorry. So you owed him 8,700
Right,
and then you got a discount? You
yes,
got paid cash, and then where's the discount recorded? In the general ledger?
right here. Here's your purchase discount right there. There's the $87.
Okay,
Yep.
got it.
Yep. The ledger, the AP ledger is only interested in the accounts payable piece,
Got it.
what we owe. And then at the end, you prepare a schedule of accounts payable, which is quite easy. All that is a list of your vendors and how much you owe them,
Mhm.
typically in alphabetical, and there it is right there. You see that total number, $11,900, Carrie? At the end of the month, that better be the balance in the control account, accounts payable in your general ledger, right?
Right.
They have to be the same. They must be.
Mhm.
The auditor comes in and he said, okay, you have 11,900,000 in the ledger. To whom do you owe that money? And you would produce this report for the auditor.
Got it.
And then the auditor might start contacting these people to verify their information. Okay?
Mhm.
We're not going to worry about finding errors. I'm getting sick of that. And that's our entire presentation today, ladies and gentlemen.
All right.
Yeah, you got any questions on anything? Anything surprising here or?
I think I asked them as we went along.
Yeah, in my my in-person class, the other day, I taught both chapters 10 and 11 at the same time. You know,
Oh,
did them back to back, and I think that's probably a better way to do it.
yeah.
Because each chapter itself is not that much, and you
Mhm.
bring them together at the same time, I think it might be more effective, you know?
Sure, sure, sure. Yeah, that makes
All
sense.
right, all right. You going on any nature hikes this weekend? You're back in the
No,
jungle?
my mom had surgery, so I'm taking care of her. So,
Oh, okay.
yeah.
Yeah, yeah, take care of mom.
Yeah.
All right, well, I guess we'll call our meeting to a halt, okay?
Thanks, Bob.
All right, Carrie, we'll see you later. Bye-bye.
Thanks. Bye.